Welcome, everyone. My name is Sarah Potter, and I am the Director of the Financial Wellness Program here at UCLA. We're really excited to see all of you. While this presentation is geared towards our graduate students, and we'll cover the various ins and outs of how to start investing, the basics of investing, and we have Wescom representatives here with us to help answer some of your investing questions. We also recognize there may be a few undergrads who have also joined. So all of you are welcome. We'd love to see your faces, and if you can turn your camera on, that would be great. Without further ado, I'll let everyone go ahead and introduce themselves.
Hi, everyone. My name is Valentina. I'm the other graduate financial wellness consultant.
Hi, everyone. I'm Charles, and I work as the research assistant peer coach for FWP, and I'm also part of our investing committee.
Hi, everyone. My name is Jasmine. I am also a peer coach with financial wellness, and I'm also on the investment committee, and I am really excited to be here.
Hi, my name is Sal Murguia. I'm with Wescom Credit Union. I'm a partner development representative with Wescom. I'm happy to join you all on this presentation, and I'll be happy to answer any general Wescom questions that you may have.
Hi, everyone. I'm David Jabzinski, and I'm the Director of Investment Services at Wescom Credit Union. Great to be with all of you on the phone here, and I know it's been a few months since we did one of these calls before, so eager to provide some updates and give some guidance and direction on what's happening in the market. And also, I'll turn it to our financial advisor that covers our UCLA branch, that's Carl, and he can go through a quick introduction.
Hey guys, great to be with you. My name is Carl Gerstenacker. Like DJ said, I'm the financial advisor that covers the Wescom Credit Union branch in Culver City and in UCLA as well. So I'm happy to be here, happy to answer any questions later on the call. Thanks.
Thank you, everyone. With that, I'm going to turn it over to our investing peers to start the investing presentation. We will have a pretty lengthy question and answer session after their presentation, but if you do have any clarifying points you would like addressed throughout, feel free to chat them in, and Valentina will be moderating the chat. With that, I will share my screen and start the presentation. So take it away to Jasmine and Charles. Let me click that.
Hi, everyone. Thank you for coming. So we're here partnered with Wescom Credit Union, and this is our presentation. It's going to be a real quick 30-minute breakdown of everything that you need to know about the investing basics. So it's like an investing basics 101 compressed, and it'll be every knowledge that you need to know. So continue. So some of the basics that we'll be covering, just to give you guys a little overview, is that first thing we'll be covering is the effects of compounding interest and inflation rates, because we understand that like the compounding interest is a good thing, inflation rates is a bad thing. So you need to understand how to balance between those two. There's risk versus, the second thing is that there's always risk versus potential rewards. So the higher risk you take, the greater your potential rewards. And we're going to tell you why it's such a good thing to start investing. Later on, we're going to talk about the different types of investments and the differences that mainly a lot of people want to know about, which are stocks, bonds, mutual funds, index funds, and high yield savings accounts. And later on, after that, we're just going to talk about some common terms and definitions when investing in stocks. So for those who are interested in stocks, you have a better understanding about, you know, if you go on to say Yahoo Finances or Morningstar, you see all these like little different names like PE ratios, EPS, all these stuff. We're going to explain that to you so you get a better handle of how investing works with stocks. After that, we're going to talk about some IRAs, individual retirement accounts, you know, in case you're interested in retiring, that's a type of investment. And finally, we're going to give you some helpful strategies when you go over investing. So little tips and tricks that helps many over the years. Thank you. So first thing is that what is compounding interest and kind of how does it work? Well, so how compounding interest works is that what it does is it's like exponential growth, as you can see here on the graph. Right here, you can see that how it works is that it takes your current principal amount and it'll take a percentage of that interest and increase it to become the new principal amount. So for example, you'll see here, let's say from 2000 till 2020, all right? So we see here that after 1 year, it grows your let's go with the green line. You approximately have about, say, $100,000. Then after that, the $100,000 after, say, 3 years, after compounding that interest will increase and you'll have close to $200,000. And after 20 years, that $100,000 can increase up to close to $1.5 million. So this is how kind of the effects work. To kind of give you guys an example, let's say that you have $100. Let's say that's your current principal amount. And let's say that you're getting paid a 10% interest rate. After that, you will have, when you calculate the interest rate, you'll now have $110. Then if you do that again, you'll now have $131 because you'll be taking the current principal amount, which was 110, times it by the 10%, and then you add that in there. So it keeps adding the effects. So you kind of see how the effects of compounding interest works. And the longer you hold the investments, the more money you'll have in the future. So best thing that we can say right now is start investing earlier. That's kind of the whole point of this slide. Next. Oh, next. Lucy? Oh, next. You're good. So now you guys get the understanding of compounding interest. Now there's kind of like the other side of the coin, and this is known as inflation rate. So how inflation rate works is that it kind of decreases the power of your money, of the current money that you have in your pocket. So let's say that, for example, you have $1 in your wallet, and let's say that inflation rate is about 2%. That $1 is no longer worth $1 in your wallet. Because of that 2% decrease in or increase in inflation rate, you now have, it's now worth 98 cents. So that's kind of how the work of inflation works. But some people might say, hey, what's so good about inflation rate? Well, the pros about inflation rate is that debitors can repay loans with less valuable money, if that makes sense. So it's good to keep in mind that when you think of something, let's say that you put in an investment and it's a 10% interest rate increase every time, but then you need to calculate in the inflation rate. Let's say you have a 10% interest rate with a 2% inflation rate. In essence, you're actually gaining 8% net interest rate. Next. So that's kind of how the little gist of overview of that works. Now we're going to talk about some risk and potential rewards, and something I took this from my peer coach, Jasmine. She's really great at this, but it's basically asking, you're going to ask the 5 W's of investing, all right? But first, we're going to talk about what is risk. Risk is basically the ability to absorb investment plan, and you're able to absorb that loss. So you're willing to take that risk and say, hey, I might lose this money or I might not. So that's the definition of risk. So now to the 5 W's of investing is, what is investing? Well, investing can be thought of as like a monetary fund to increase your money for the future. So you put in a little money into here, over time it will start growing, compounding, and you'll have a lot of money in the future. Who's investing? Well, you guys, you guys will be the one investing to help yourselves in the future. So, in case you retire, you'll have money for that. You can't rely on, like, say, social security money, So, that's why we have IRA accounts, which we'll go into depth later. When you should start investing? Now would be the best time, because as you've seen right there on the chart of compounding interest, the earlier you start, the more money you'll be able to compound and exponentially grow. Rather than a linear growth, it's exponential growth. Why you should start investing? Well, it's an effective way to put your money to use and start building wealth. You know, if you're having some money in like your savings account and it's like extra, you know, you have enough for your rainy day, you have enough for rent, and you know, you instead of just having to sit there getting interest about like 0.01% interest a month, you know, it'll actually, now you put it into say bonds, it'll probably gain probably like 5% interest per month. So it's better to build your money that way. And where you can start, you know, there's plenty of places. We'll give you guys some more at the end, but you know, you guys can ask your local bank provider, financial institutions, private companies. Wescom Credit Union can also help you with that. So yeah, next. So right here is a general overview of what I was talking about, the risk versus potential rewards and the types of investments. So you can see right here at the lowest type of risk are treasury bills and CDs, which are certificates of deposits. These will yield the lowest reward, but they'll also have the least amount of risk. After that, you have something called bonds. This includes government bonds and corporate bonds. After that, you have something called stocks. You know, commonly when you talk about investing, you hear about stocks. There's something known as preferred stock and common stock. And then finally, you have something known as options and futures. Options and futures include like say Bitcoin, real estate, gold, all that and more. Next. All right, so some of the types of investments that we're going to be talking about are cash alternatives, bonds, stocks, options, and futures. These are our four main ones that we will be going over throughout the whole presentation. So to give you guys a, next. Give you guys the actual definitions of everything and how they work is, so when we talk about cash alternatives, we're talking about the two main things are treasury bills and certificates of deposits. And the other one is money market deposit account and high yield savings accounts. And these are usually paired because they're very similar, but they're not the same. Oh, back. Can you go back? I think it went over.
Yeah, sorry, 1 second.
No, you're good. All right, so how treasury bills and cash deposits work is that you basically pay a fixed amount and it earns interest. The thing about this is that these ones tend to have a lower risk investment, which also means that they'll have a lower yield, a lower potential returns. So basically it's like you put money inside this account or bill and it earn very small amount of interest. Then you have something called money market deposit accounts and high yield savings accounts. And I always love talking about high yield savings accounts because basically it's like a savings account, but it's better. For example, your savings account at your local bank might give you like 0.01% interest, which is like 3 cents if you have $300. But let's say now you go to a high yield savings account, you could get up to 2% interest rate. And say you have $1,000 in that savings account, that's $20 right there, free, you know, and it's added to your bank account, to your savings account. So that, and it compounds. So basically how these work is you deposit money into account and have it grow over time. They work very similar to a savings account, and they typically have generally a higher interest rate than your standard local bank savings accounts, which is like 0.4% versus like 2% interest rate. Now we're going to talk about bonds. There are two types of bonds, corporate bonds and government bonds. The reason why government bonds are on the lower risk part, but they have a lower returns is because they're backed up by the government and the Federal Reserve compared to corporate bonds, which are corporations that give out these bonds. And to kind of give you guys how a gist of how bonds work is that basically you would pay money and then later on the government or the bond provider will say, hey, I owe you this amount of money, principal plus interest. So let's say that over time it'll build interest. Usually it's not a lot of interest, but it's a good amount of interest. And over time it'll start building, as I said before, compounding interest. So by the time you're able to redeem it, you'll gain all that principal amount plus the interest that you'll gain off of it. The thing about bonds is that you're not allowed to redeem these bonds until the date, and they'll specifically say the date of when you can redeem it. For example, it might be 10 years later, in 2030, that's when you'll be able to redeem this bond. So you have 10 years of interest building on that. Corporate bonds work the same, pretty much the same as government bonds, except they're backed up by corporations. That means like if a company goes under, you could lose your bond completely. This is called like default. So if a company goes by default, there'll be no chances of practically little to no chances of you being able to get back your bond money or the interest rate at all. They do come with a higher interest on corporate bonds, but keep in mind that they also have with a higher risk. Next. For stocks, when it comes to buying stocks, there are actually, to kind of give you guys, let me give you guys the definition of stocks. It's like basically it's buying a portion of ownership of a company. You can sell your stocks for a gain or loss, and it depends, the gain or loss depends on the company's performance. And you always want to, this is the number one tip when it comes to buying stocks, is you always want to buy low and sell high. To kind of give you guys an example, let's say I buy a share of Apple for, I don't know, $50. And then later on, Apple next couple months, they do really well, their performance is really well, and their stocks are now worth $100. Now, if I sell my stock, I will get $100 worth of it. So that's how stocks work. That's how, they don't do an interest rate system, but they do that. Now, there's a difference between something called preferred stock and a common stock. Preferred stock are generally a lot higher in cost, but the good thing about them is that you do get paid dividends. And how dividends work are, they're kind of like, basically they're thank you to saying like, hey, thank you for putting so much money into this company. So they'll give you a portion of, say, like maybe 10% of your stocks. Let's say you have $100,000 worth of stocks, and we'll give you 10% dividends from that. So you'll get $10,000 into your money, and you can choose to reinvest that into the company, or you can choose to keep that one. Common stock are generally the cheaper type, and as they say, common, so it's meant for kind of like the people, common people to buy. They're cheaper, they're affordable stocks. Keep in mind that when a company does go under, let's say it does go under, they're obligated to have to pay off the preferred stock first, because those are the higher investors. Then they'll have to pay off the common stock. That's why if you saw on the chart, preferred stock is lower risk compared to common stock. And stocks have something called ETFs, or exchange traded funds, mutual funds, and index funds. And we'll talk about that later in the next slide. We're going to talk now for the other one. Last thing we're talking about is other options and futures. These have the highest return, but also have the highest risk. For example, you might have something called cryptocurrency, Bitcoin. You basically, you're investing money into like an online system of currency. And then you'll hope to get some returns off of that, similar to stocks. You'll be able to sell these Bitcoins for a higher rate, and they'll also build money over time. Real estate, for example, 2008 crash, the real estate went really low. You could buy a house really cheap, and now people are renting out those houses or selling those houses for a higher amount, but it doesn't always work. For example, people before the 2008 crash, they might have bought real estate, but it might not have worked out so well for them around 2008 when they try to sell it. And collectibles, this could include gold, jewelry, comic books, vintage stuff, cars, whatever it is. But maybe people might not be interested in these collectibles anymore. Maybe they might have it for a higher value, maybe they might not. So that's why they have a very high risk. It's like really high. Yep, next. All right, so now we're going to talk about the different types of between types of investments. So as I was talking about, high yield savings accounts, they have low risk, low returns, about 1.5 to 2% interest rates, and they do have better than normal standard savings accounts. So it's good for people who are risk averse. If you're not like a huge risk taker, but you want to earn some money and invest, high yield savings accounts are for you. Bonds are more in the medium realm. They're low to medium returns though. And they are for people who are like a bit of a risk taker, but they're not a super risk taker, a little bit risk adverse. So it's a bit of both. And just to clarify, there's something called trash bonds. They're a high amount of interest. They have a high amount of interest, but they're typically given out by corporations or companies that don't have a lot of performance well. So they have a high risk of default. So henceforth, they're trash bonds. You can have a high risk of earning that interest, but there's also a high risk of that company going under and defaulting. ETFs, as I was saying, they're similar to stocks, but they have a higher risk and higher potential returns. And they have something called diversification, which we'll talk about later on. This is an important concept, diversification, when coming to stocks. There are different types for different industry specializations. You know, you might have one for, like, say the S&P 500 consists of the top 500 companies in the world. Or like you might have specialties like international tradings. There are different types of ETFs out there. You know, feel free to research into those. You do have to pay a small fee for the financial manager to help manage your money, because these are actively traded and managed by someone. So that means they're always trading them. You know, they're not like building money over time. They're finding which ones are the best returns for you guys. There's something called mutual funds. They're similar to ETFs, higher risk, higher potential returns, instant diversification. Great thing about diversification. But you do also have to pay a fee. You know, these fees are higher than the fee for ETFs and or financial managers. They're generally passively managed, so usually the manager will put them in the account and, you know, let it grow over time, rather than like saying, hey, I'm going to trade this because I know this one will give you the most returns. Now you have something called index funds, and similar to stocks, they also have higher returns, higher potential risk, instant diversification, and they take your money that goes into a group and basically into the like top well-performing companies that these managers see it. For example, the S&P 500, the NASDAQ, you know, the S&P 500 consists of, as I said, the top 500 companies in the US. So they take it and then they group all your money together with other people's and put it into these accounts that say, hey, these will get you money over time. Next. Yeah, so keep in mind you can have a combination, and it is highly recommended that you have a combination of, you know, either all of these or some of these, depending on which ones you like, you know, bonds, stocks, high yield savings accounts, IRAs. All these is kind of like the concept of diversification. Important concept you want to know is that don't have all your eggs in one basket. What basically that means is, like, for example, if I have $100 and I put all that $100 into Apple, what if Apple goes bankrupt the next day? Then I lose all that $100. Instead, I'll say I'll put $50 in McDonald's, $20 in Apple, $10 in Walmart, and that way it's spread out. So if one company goes under, I won't lose a lot, but I'll still be building money. Next. So that's the concept of diversification. So let me see here. Oh, Jasmine? Yeah.
Yes, thank you. Thanks, Charles. That was an excellent recap of a lot of the basics with investing. I'm going to dive into a bit more detail. Also, I hope my Wi-Fi does not cut out again. But if it does, that's why I disappear into the void. And so really quickly, I know we don't have that long left for this section, but I want to clarify a little bit more about ETFs, index funds, and mutual funds. I know they all have fund in the name, but there are some important differences that I want to highlight. Mutual funds sort of came around first. I consider them the baby boomers. They've been around the longest, and they have instant diversification, but there's usually a manager that manages the fund, so it's technically considered actively managed. So since someone is picking the funds for you, even though it is diversified, there's going to be a management fee, and fees eat into the profit. So when index funds came around, they're sort of like the millennials. They're the new kids on the block, and they also represented instant diversification, so they're a category of mutual funds. But what makes index funds really cool is that because they just track an index, there is no person managing that money. So there are no associated management fees. So these passively managed funds have much lower expense ratios compared to actively managed funds, but you get the same amount of diversification. And instead of trying to beat the market, which we know is very hard to do, you are just, sort of riding with the waves of the market. And then ETFs are the newest kids on the block. I consider them the Gen Zers. And how I explain them is it's like if a stock and a mutual fund had a baby, because a mutual fund offers diversification and a stock doesn't. And so an ETF will track an index or a sector, and so they have built-in diversification. But an ETF is also more liquid, so it trades like a stock. So if you are interested in more actively trading, you might want to do an ETF over a mutual fund or index fund because of that liquidity. So that's just a little bit more of a breakdown on the different types of funds. They're all great options. And again, we want to highlight that diversification is key, and these all offer sort of instant diversification. Now when we're talking about individual stocks, you know, there are a lot of terms that come up. There's a lot of jargon, and I think it can be intimidating. So just to unpack some of these terms, you know, you can also read them on the screen, so I won't go over everything, but some important concepts I want to cover is, you see that there's a bid and an ask price. And so I like to think of bid as demand and ask as supply. And the reason it's important to know these terms is because there's something called the bid-ask spread. It can be a little complex, but it is a measure of liquidity, right? So a tighter spread, a smaller spread, indicates more liquid security, which makes sense, right? Because it means that the price that someone is offering versus the price that someone is willing to pay is closer. It's more likely for a transaction to happen, more liquid, it's easier to convert to cash. Also, PE ratio and EPS, there are a lot of financial ratios that are used to evaluate a company. PE ratio and EPS are two of the really important ones. They're pretty basic. They're sort of like the bread and butter of fundamentals. I'm going to start with EPS because EPS actually feeds into the PE ratio. So EPS is earnings per share. It's a really common ratio. You can Google it for any security that you're looking into. And it's an indicator of profitability. So it's a little more complex than this, but the very basic way to think of it is net income over number of shares outstanding. So a higher EPS is good because that means that with the capital that the company is getting, they're able to turn a higher profit, right? They have a higher net income relative to their shares. The PE ratio is sort of like a measure of how well the company is doing. So it's going to divide the current stock price by the EPS. And so at the PE ratio, there's sort of a trade-off, right? A higher PE ratio might seem good, but it could also mean that the company is overvalued, right? So like a lot of tech companies will have a really high PE ratio. So relative to their earnings, they have a really, really high stock price. That could mean they're really profitable, or it could mean that investors are overvaluing the worth of the company. On the other hand, if you have a low PE ratio, it might mean that, you know, the company is not that profitable, investors have low expectations and confidence, but it also might mean that the stock is undervalued, and that might be a great opportunity to buy. So you'll have to do more research yourself, but these are just some common ratios to help get you started. Okay, and I will move along a little bit faster. We can go to the next slide. Okay, so IRAs. So IRAs are my bread and butter. They stand for individual retirement accounts. And I know that when we think of investing, we don't really think of retirement, but in this case, we should. There are two types of individual retirement accounts, and there's traditional and Roth. And I'm going to focus on the Roth because I am assuming that we are all college students, we are going to graduate soon, and we might be in a lower income bracket. And if that is the case, we should really consider looking into a Roth IRA, because a Roth IRA offers an advantage that basically no other investment account does, which is tax-free growth. And tax-free growth is huge. It is a really big deal. You almost never see the words tax and free together in the IRS code. It's to incentivize young people to save their money for retirement and invest. How a Roth IRA works is that you invest money that you've earned. So that money is already taxed, right? When you get your paycheck, you know, taxes are already taken out of it. You put it in a Roth IRA, you find some investments, and then that money grows over time. When you take it out when you're older, that money, when you take out, is tax-free. You're not paying taxes on the growth. You're not paying taxes when you take it out. So you're only paying taxes when you put the money in because it's earnings from your paycheck. And because it's assumed that you're in a lower income bracket, because there are thresholds for the Roth IRA, you know, the taxes aren't that significant. And it has the potential to grow a lot over time, thanks to the beauty of compound interest. And some important notes with the Roth IRA and traditional IRA is that both the annual maximum contributions are $6,000. Now, if you don't qualify for a Roth IRA because your income is above the threshold, which for 2020 is $139,000, you can get a traditional IRA, and the growth is tax deferred, which is great because you're in a higher income bracket. So you're not going to be paying taxes on the earnings when you put them in. You'll pay taxes when you're in retirement, when it's assumed that you're in a lower income bracket. Also, and this is, you know, a little bit more complex, but something to consider, that even if you do have a traditional IRA, you can roll it over to a Roth IRA. There are some taxes you have to pay, but there's still ways you can take advantage of the Roth IRA's tax advantaged accounts. Okay, next slide. Okay, so I think we covered this. We can move on. Okay, so 401ks and 403bs. The main thing I want to cover, since this is geared towards graduate students, is a lot of you might be in a position where you have a job and maybe your employer is offering a 401k, but now you know about like this Roth IRA and you don't know, like, where should I invest first? How do I prioritize my money? And so, you know, everyone's situation is different, but the general rule of thumb is that if your employer is offering a 401k match, you should 100% start with that and max out that match. A match is essentially free money. If your employer, and not all employers do this, a lot of 403Bs don't offer matching, and not all 401Ks offer matching, but if they do, a lot of people call that free money on the table. You know, that is money that they will match for whatever you put in towards retirement, and you know, you technically didn't earn it. They're just like, hey, we want to incentivize you to save for retirement. Here you go. You really can't beat free money. You know, I think the Roth IRA is awesome and tax-free growth is great, but nothing beats free extra cash. So if you're in a situation where you want to start saving for retirement and you don't know where to start, if your employer is offering a 401k match, 100% contribute up to that match because you can't beat free money. Once you max out your match and you still have money left over and you want to save, max out your Roth IRA. That's $6,000 that you can do per year of tax-free growth. You know, it's the second best thing to free money is tax-free growth. And then if you're in this great situation, you know, you've been saving up, dealing your debt, and you have, you know, maxed out your match and you've also maxed out your IRA contributions, you can go back to that 401k because the maximum amount is $19,000. And even if you're not getting that match or tax-free growth, 401ks do offer the advantage of tax-deferred growth. And that is still better than your traditional taxable investment accounts. So again, I know that some of you may be in this situation where you're going to be recently graduating and you want to start saving for retirement, but you don't know how. You really want to look at your individual situation, but in general, you should start with the match, and then you should max out your IRA contributions, and then you should go back to that 401k because it goes free money, tax-free growth, and then tax-deferred growth. And that's just a general order that can sort of like a framework you can use to help you decide where to put your money. And hopefully we covered that. Next slide. Okay, so some general, I know we're running low on time, but just some general strategies, as we've said, before you start investing, you know, you want to have an emergency fund. You know, I know a lot of people are saying right now is a great time to invest, and that is true, but investing is not that liquid. So you want to make sure that you have, you know, up to 3 to 9 months worth of basic expenses or rent payments in an emergency fund that's easily accessible, you know, hopefully in like a high yield savings account, a CD, before you start investing. When you buy stocks, as we said, buy low, sell high if you're not buying and holding, which would be like something for retirement. High yield savings accounts are great. I know we've been hitting them hard, but traditional savings accounts, you know, they don't tell us this, but they have really, really low rates. So high yield savings account is a way to still have relatively easy access to that money, but you're earning a little bit more interest and you're sort of beating out inflation. Diversification. Diversification is key. Whatever investment strategy you go for, just make sure that you are diversified. You know, there's a saying, don't put all your eggs in one basket. It's a saying for a reason. And also do your research. You know, we've covered some of the fundamentals and ways to identify company profitability and value. Just make sure if you're investing in, you know, individual stocks or funds that you do your research. And the most important thing you can do is, you know, be knowledgeable, be relatively safe, and be confident in what you're doing. And okay, places to start. So of course we have our lovely Wescom advisors that will talk more. Credit unions are great ways to, you know, save, invest, do all sorts of financial transactions. There are robo advisors, which are online platforms. Some really great ones are Betterment and Wealthfront. And then we have, of course, our traditional brokerage firms, which are like Fidelity and Charles Schwab. Also, Yahoo Finances is a great place to get more information about investing. But, you know, today, you know, the investment process compared to what it has been is relatively democratized, and we have so many options. So there's something out there for everyone. Thank you for coming. I know that this was a lot to unpack, but hopefully we have a decent amount of time for the Q&A portion so we can elaborate on any questions you might have. But, you know, the important thing is to start now and start young. So you've already done the first step, which is the most important step. So you should all feel very proud of yourselves for being here.
Thank you so much, Jasmine and Charles. That was awesome. Let me stop sharing my screen. And maybe I could quickly turn it over to Wescom for any financial tips you guys might have, and if you guys want to talk about the services that you can offer to students, and then we'll turn it over to a robust Q&A session. So take it away, Wescom.
Okay, so hopefully everyone can hear me okay. Thanks, Lucy, I appreciate it. Is there a way to share my screen? I don't know if that's possible. If not,
let me make you a co-host.
Okay. All right. Thank you. I was just going to share the quick handout there and just touch on a few things.
There you go.
All right. Thank you so much. Okay. So can everyone see my screen?
No, not yet.
Okay. Not yet. All right.
There we go.
All right. How's that look? Okay. So real quickly, great job, you guys. I mean, you guys just hit everything so important about the market. You know what's interesting? It reminds me, as we went through all this, a quote Warren Buffett always talks about that, you know, when you invest and you invest in the stock market is about taking money from people that are impatient and gives it to the people that are patient, the people that are wanting to stay invested for a long time. And that's, of course, how he's made his wealth as probably one of the best individual investors of our time. So with that as a background, I just wanted to highlight a couple things. First of all, and this may be on everyone's mind right now, is student debt, right? And, you know, it's interesting. So this is something that we put together from one of our databases that, you know, allows us to just pull data together. And this is interesting. It just talks a little bit about student debt. And, you know, as all of you on the phone may be thinking about this, student debt is actually the second largest consumer debt that's out there. And of course, the number one is being mortgage debt. So right now there's well over 1.5 trillion. So as we've gone through this market downturn and slowly a beginning of a potential recovery, you can see that this is on everyone's mind, not only the individuals that do have debt, but you can see individuals that are in older peer groups, 30 to 40, 40 to 50. It's just amazing that this is on everyone's mind right now. So given the fact of we're going through this downturn right now, just know that there's a lot of organizations like Wescom and individuals that are servicing the debt that can actually help individuals. And I know you guys may have seen this already, but I'll just kind of point this out real quickly. So the CARES Act, of course, was signed in right as the COVID-19 started to happen. And so March 27th, they signed this into law. And it talks a little bit about federal loans. And of course, there is an opportunity to have the payment suspended. So there's some different things in there. There's forgiveness programs as well as suspension of your payments. And so one of the things that you'll see in here, and I think I send this over, is if you don't know who is servicing potentially your loan right now, what I would do is you can click and use this site here and it'll actually help you, or you can call into this site. But if you do know who your servicer is, reach out to them. Just like the servicer of your specific loan, Wescom has a lot of programs such as skip a payment, defer payment towards the end of the loan. I mean, there's a lot of different things going on. And I know right now our politicians are out there looking at potentially signing in another bill. The reason this is real important because as we're talking about investing, if you can control some of the money that's going out, such as a student loan, that can actually free up money to do other things. So again, I just wanted to kind of quickly just point that out. And then just one other thing that I also wanted to kind of point out here real quickly. You know, I can't even believe how quickly now this year is already gone. It's you know, we've been working remote as an advisor team for about 2 months now, and we're coming up on mid-year. And I think everyone knows that July 15th now is the new tax filing deadline. So just keep that in mind. But just some things to keep in mind as we're coming into mid-year is, you know, take a look at a lot of things that affect your finances, you know, taxes, things like that. Making some New Year's resolutions, even though it's mid-year, it seems like January's almost like a different year. It just seems like years ago because the world has changed so much. But these are just some of the things to keep in mind when we sit down with members of the credit union that we want them to look at and consider. I know there was a lot of questions on 401k and IRA, which we'll talk about in just a couple of minutes. But final thing, and you guys have this to take a look at it at any time you want to, but there's something about the market, and you probably have heard of this. It's called behavioral finance. We've talked about today a lot of different things such as PE and different ratios and things like that. But there's also this other thing called behavioral finance. And what's interesting about that is it's just how people react when the market goes up and the market goes down. So what's interesting is last time I was on this call, it was April 7th. April 7th, we did a call, and I believe it was with the undergrads. And at the time, the market, the Dow Jones, that's 30 companies put together, was 22,653. Now, we talked about the fact that this will recover, but the market was down from where it is today, well over 3,000 points. Now, the close today was 25,358. Long story short, for those individuals that were patient, they stayed the course, and they didn't get upset about what was happening. They absolutely got to participate in what the market has been doing the last time we got together with all of you on the phone. In fact, the market low was right around the third week of March, and that was about 18,800. We've come up significantly, but we're not back where we were. But just know, as you invest, there's different emotions that we all feel. And this slide here just talks a little bit about different individuals and how they feel. What's interesting is as you get closer to retirement or you are retired, and this slide shows that 63% of your emotions are about the market and about your account and the value, because you don't have a lot of time to earn that money back. So you can be more emotional about what's going on. So I just wanted to share this. Talks a little bit about behavioral finance, and there's a lot of work being done right now on that and different ways to actually invest in the market based on that. So just wanted to share that information. And then the final thing, hopefully everyone can still see my screen here. This is just something I thought I'd also put out there. It just talks a little bit about duration and effects of recessions. On the call last time, I brought up the notion that we are absolutely already in a recession. I think some of the numbers that we're seeing are showing that. However, we're also seeing this quote unquote, some of our politicians are using this pent up demand that people do want to get back out and have some sense of normalcy in their life. This just talks a little bit about recessions and how long they last. On average, they're about 11 months, so less than a year. But just know, they can be much shorter than that. In 1980, it was 6 months. So just know, if we are in that now, there is a lot of things that are happening to try to change, the dynamic where things are going to start to recover. So there's going to be light at the end of the tunnel. It may not feel that way now, but I can tell you the financial markets have gone up significantly, which means investors' wealth has gone up, which means confidence has gone up. So it's just going to take a little bit more time. So on that note, I think we wanted to potentially go through some of the questions. And then Carl and Sal, I know the two of you are on the line. There's a lot of questions on IRAs, 401ks. And so maybe we tackle a few of those questions. And maybe Carl, if you want to take a few of those.
Thank you so much for all of that information. And as DJ said, I will be sharing that document with all of you tomorrow. So you can have that to reference at your convenience. I saw, this sounds like a really good question to start off with that I saw in the chat. Let me look. Probably for Wescom, if you'd like to take this question, but it says, is it better to get a loan at a bank or a local credit union such as Wescom, and what are the pros and cons?
Would you want me to tackle that one, DJ?
Sure, sounds good.
Yeah, thank you for the question. Basically, whenever we advise people to, when they're looking for a loan, it's basically, we're going to try, at a credit union, we're going to tell you what's best for you. We're a non-for-profit organization. So anytime I'm involved in a financial advisory role, I'll always say, what's going to work out best for you? And what's going to make you feel most comfortable in how you're going to get that loan. Now, what most people look for when they're looking for a loan is a low interest rate, and they're going to look at the rates and the terms and conditions that suit their financial needs best. So perhaps you can get that at a bank, perhaps you can get that at a credit union. What we try to do is, or what we advise to you, is to do your homework, make sure you're doing business with an organization that you're comfortable with. If that happens to be a bank, that's fine, but understand that banks are for-profit organizations, so they have to reach certain profit margins and look at some of the bottom line in terms of making some decisions, whereas credit unions are non-for-profit organizations. We don't have a profit motive in doing our business, and we just speak to what we can offer to you. And it's not in our best interest or business interest to get you into a bad loan. So that's something to consider and to think about when you're applying for a loan, no matter what type of loan it is, whether it's a personal loan, auto loan, home loan, credit card. So that's just something that it's up to you as a consumer. But working for a credit union, being at Wescom Credit Union, we sure welcome your business and we'll give you the best advice that we can give you.
Something just to add to that, hopefully everyone, yeah, okay, I'm not on mute. Something to add to what Sal was saying too is at the credit union, we are focused on retail or what we call individuals. We don't do business loans, so it's just on our traditional retail members that do come in the branch. So whether you're looking for a, maybe a line of credit or an auto loan, what have you, there's a lot of different programs that we do have. And so, so the nice thing is we are very focused in a certain type of business. Sometimes commercial banks can do a lot of different things, such as business loans and things like that. We just focus right now on our members, which is retail, or what we call individuals that are looking for, really households. That's really our focus.
Thank you so much. The next question I see from Andy looks like a clarifying question. What is the difference between a 403B and a 457B? If anyone has the answer to that.
Sure, I'll take that one, guys. So great question. So both of them, I'll start with the similarity. Both of them are employer-sponsored retirement plans. The difference typically in the tax code is that a 403B, normally that's something that's accessible for you guys if you work in the education sector, right? So a university or a school. 457B normally is a retirement plan that's accessible if you work for a municipality, for example, for a county or a city. Normally, one thing to remember with all these terms, with 401k, 403b, 457b, is an IRA as well. They're all considered, there are retirement accounts, right? So what's important is, one, to start contributing to those, but really the investments that you have inside of these accounts. Normally, like Jasmine was saying, they're going to be mutual funds, index funds, ETFs. And we can touch on that in a second if you like, but that's the main difference between the 403B and the 457B.
Thank you. It looks like our chat is popping
Blowing up,
which is fantastic. I'm glad everyone's so engaged. Let me scroll back up to try not to miss any. But the next one I see is, are non-resident aliens or resident aliens eligible for IRAs or 401ks?
DJ, you want me to take that one?
Sure, go right ahead.
All right, guys. You can chime in if you like as well. The answer is, in order to open up an IRA with most brokerage firms, at least at Wescom as well, is as long as you have a social security number or a tax identification number, you're able to open up an IRA. When you start working at your employer, most times they're going to ask for that anyway when you start working. As long as that's something you provide them, you should have access to your employer plan.
Just a follow-up question I have with that is, what advice can you give to international students who are maybe looking to start investing? Are there any particular ways that you'd recommend to go about that?
Yeah, that's a good question. To start, I mean, I always believe investing is very important to do. When it comes to retirement accounts, one thing you guys want to consider if you find yourself in that situation is your withdrawals down the road. For example, on a retirement account, taxes might be a little bit different if, let's say, you're a student, you graduate, you get employed, you're working, you're contributing to a 401k, for example, and years down the road, you decide, you move back to your home country. And where you'd want to consult with probably a tax advisor is when you start taking withdrawals or distributions from your retirement accounts. We can kind of dive in on the rules behind a 401k. Age is important there. With any retirement account, 59.5 is kind of that magic number. That's the age where we're able to take distributions or withdrawals from these retirement accounts without any sort of penalty. So again, kind of the advice I'd give there, when it involves retirement accounts, you want to consult probably a tax advisor to kind of see what the consequences might be down the road. To start off, again, as long as there's a tax identification number, you should be able to contribute and invest. But I guess the more complex question would be down the road when you start taking withdrawals from a tax perspective.
Hey, Lucy, just to add one thing to what Carl's saying too, and I know this question came up before, and that is, and I think it was actually in one of the questions that came over, and it just talked about either stipends or fellowships, and I just wanted to quickly clarify that. So if you are receiving a stipend or a fellowship, there was a rule change as a result of the Secure Act, and so basically what that means is for 2020, so for 2020, they are looking at including that now for the purposes of eligible compensation for the purposes of IRAs. So that's something to consider. I know some of the questions were, what's a great way to get started with investing? Well, that could be if there's additional money from your stipend or your fellowship, it now could be potentially used for contributing to your IRA. So that's great. And that's a rule change for this year that was not available. And because of this pandemic, this COVID-19, it's amazing how many different rules have been already signed into law, as well as new ones that are coming out. So, what I would absolutely say is, as you get started, no matter what it is, if you're, whether it's your loan payments or anything, reach out to your financial institution. We are helping. We've helped, I want to say close to 3,000 of our members right now. We have 200,000 that have called in and said, hey, you know what? I may be late on my payment, or I need to defer my payment. I think right now it's really important to make sure that you hold on to the funds that you have, especially as we go through this. Hopefully no one's been displaced from a work standpoint, but if you are working, I know companies are starting to open up. It's real important to make sure to hold on to what you have right now. And a lot of companies are willing to give you that break. But again, I just want to point out the stipend piece, because stipends and fellowships are now part of the compensation piece.
Yeah, thank you so much. That was extremely insightful. Let's see which other ones I missed. Another question I see in the chat is, does being undocumented affect my ability to do any of these type of investments? And if so, maybe what recommendations do you have if an undocumented student was looking to invest?
You can go ahead, DJ.
Yeah, and I think it's what Carl was just mentioning about the tax ID. I think that's going to be very important. But what's interesting is there's a couple of different ways, and you guys did a great job covering the different programs out there. So we have a couple of ways that you can invest at Wescom. So the first way is through what is called an advisor-assisted program. So Carl is our advisor that covers Culver City, but specifically the UCLA branch. So we have what is called an advisor assisted program. So he's going to hold your hand and walk you through the whole process from start to finish. You guys did a nice job covering some of the other programs that are out there, which is such as Robo Investing. Robo Investing will be very much direct investing. You won't have someone holding your hand, but it's very low cost and direct, easy technology to use, and it's accessible to anyone. So that's another thought. And then another way, which we do offer at Wescom, is we do have online investing. So if you said, you know what, Carl, I think I'm good. I got a lot of good education on buying in different investments. You could go onto our website and open up what is called an eVision account. And an eVision account is where you basically will execute your trades and do everything on your own. So there's a lot of different ways. So as you're looking to invest, maybe figure out what's the best way that I can access this. Should I do self-directed? I mean, there's some great sites out there for self-directed. And here's the nice thing right now. Most, if not all, brokerage firms out there have got into a competitive war that it's really almost zero fees or commissions when placing a trade. So just keep that in mind if you're a do-it-yourself person. There's also, of course, you guys covered this, and that is the Robo Investing. There's some great sites out there. I mean, Robinhood and some of the other ones that are out there have the ability that you can get started very small amount, and it's almost like additional money that's in your account. You can just transfer into that. So a lot of different ways you can get started. But again, just want to let you know that Wescom right now offers advisor assisted, which would be Carl, and we offer the online. We don't have a robo yet. It is something we are looking at, but we don't have a robo platform at this point.
Thank you. And I know we're cutting it pretty close to 6, but maybe just a question to round it off is there any final investing tips that you would recommend for students during COVID-19? Any things to look out for, best investment practices during this time? You guys can take it away.
I'll just provide a few things, and then I'll let Sal and Carl provide some things. And it's not so much on the investing side, but one of the things that we're seeing within the credit union right now is we're seeing a lot of different scams with our members. So it's very important right now to make certain when you're opening emails or if someone's calling you, there's a lot of individuals out there trying to capitalize on this pandemic, and it's unfortunate. But just be very careful about passwords and emails and access. I mean, there's a lot of different phishing emails that are going out. We're trying to warn our members about just that. Don't open something unless you truly know, or you know what, if you get a call and you think it's your financial institution, and maybe it's not, call your financial institution back just to check in with them. So right now, just be very careful on the different things that are out there, because like I said, it's there's a lot of different things, both online and through emails and texts and things like that are happening. So that would be my kind of 2 cents there, and I'll pass it over to Sal and Carl.
Alrighty, guys. First off, thanks so much for having us. But I would say in this investment world, it can get kind of complicated. There's a lot of different terms, a lot of different investments out there, and it can be overwhelming for a lot of folks. I would say try to keep it as simple as you can. I think we covered it earlier in the call. I think from a very fundamental standpoint, you want to take a look at your personal situation from an emergency bucket, right? Just having some money for a rainy day. I think Jasmine put on here about 3 to 9 months worth of expenses just for a rainy day. I mean, we're kind of seeing what a rainy day looks like during this whole coronavirus situation. A lot of folks losing their job and unfortunately kind of going through an emergency situation. That's where the emergency bucket comes in. That's very important before even really looking at investing. And something we didn't really cover too much in depth, but kind of covering debt, right? Eliminating debt as fast as you can. That just frees up, again, from a very fundamental standpoint, clears up cash flow per month, right? It lowers your expenses per month, and you have more cash to actually put to work. After that, guys, I mean, I would say definitely utilize those retirement accounts at work, especially if there's a match. Again, it's free money. You're getting an instant return on your investment as soon as you put money into it, which is great, right? It's easy money. And really kind of looking at your personal situations. There might be other goals that you have, right? Maybe not just retirement, but you want to save for a down payment for a house. There's different ways of putting money to work in those situations, depending on when you're looking to do it. But we're available. I'm sure you guys will get our contact information. Feel free to reach out. I will be at Ackerman as soon as we open up again. So thanks, guys.
Thanks, Carl, for that. And Lucy, if you don't mind pulling up the final 2 slides that I think that I handed to you. If you could share that screen. Yeah, it just gives some contact information for everyone to see that's on the call. This will be available to you as well. Carl just alluded to it and what he was saying. But as those slides are coming up, Wescom does offer some products and services that are unique to the UCLA Bruin community. So if you're looking at making your money grow immediately, we offer a checking account where you can earn up to 10% APY on the first $1,000. And then you can get $100 with an active debit card, a $100 deposit into your account with an active debit card or a direct deposit of $500. So that's an easy way of, getting started and doing your money management in a smart way. Wescom is a partner with UCLA. We're a sponsor of UCLA Athletics, Campus Life, and we're here to help all the UCLA student body community in making sure that they're making wise money decisions. So if you need some more information in terms of investment, you can also look at this information here for David's or DJ's and Carl's contact information. You can look up all of our products and services and benefits for the UCLA Bruin community at www.ucla.wescom.org. And on the next slide, what Carl alluded to is that as soon as campus reopens, we do have our branch on the first floor of Ackerman Student Union. And just to reemphasize to everyone that's on this call, you know, I'm not here just to pitch Wescom to you, but credit unions in general as well. We're here to help you. We're here to be good partners for you in your money management career in life. Like I mentioned earlier, we have a nonprofit motive in the way that we conduct our business. We do it professionally and honestly, and we're here to give you the best advice possible that suits your individual needs. So I just can't reemphasize that enough. So again, once the UCLA campus opens, our branch opens back up, you can always walk into that branch. You can talk to one of our member service representatives, or you can make an appointment with Carl, and you can always contact us anytime online as well. And so I just want to say thank you for your time and attention and partnering and being a part of this discussion. It makes us proud to be a part of these discussions and helping the Bruin community make smart financial decisions. So thank you.
Thank you so much. Thank you, Wescom. Thank you to our investing team. You guys rocked it. Thank you for everyone watching for your attention and your amazing questions. And as Sarah typed in the chat, we do still offer one-on-one free consultations. If anyone's looking to talk with peers, we are students at UCLA, graduate and undergraduate students. If you want to dive deeper into investing, budgeting, credit, just a variety of topics, we're here and we would love to talk with you one-on-one. So you can check out our website at financialwellness.ucla.edu and you can book an appointment as well, now during the quarter and over the summer. So I want to thank everyone for your attention, and that concludes our session today. So thank you all, and I hope you have a really great rest of your quarter.